before we move into that, I need you to first subscribe, leave a like on the video, leave a comment. If we move on to 1989, Japan's GDP was actually starting to become positive. So the Bank of Japan, like most Federal Reserves, central banks, stuff like that, said, okay, our economy's doing good, but we don't want it to go too out of control. It's safe enough to raise interest rates. And when they did this, the bubble popped for all the assets, including property, stocks, whatever kind of investments they had. And essentially, they were so pumped up. They were close to about 3 times their actual value. But the other effect of this, they caused stagnation and deflation, which I'll go into a little bit later. But this was also the precursor before Japan's lost decade and Great Recession. So in response, the Bank of Japan tried to bail out financial institutions through capital infusion. Again, like I said at the beginning of the video, there's a lot of different names for this, but at the end of the day, it's the same simple BS that everybody throws at you, which is, oh, well, we just got to find a way to give these guys money so that they can do and conduct business so that it'll keep the economy turning and stuff like that, right? You can call it a stimulus. You can call it a freaking capital infusion. You can call it like window guys. You can call it QE. It's all the same garbage. Like at the end of the day, it's just, we're going to create a bunch of money. We're going to give this to you with the notion that you guys can keep operating and just keep going so that we get through this little bump together, right? So unfortunately, what happened was that these financial institutions stuck most of their negative assets. Oh, actually not the financial institutions, but Bank of Japan gave everybody money. There was no due diligence on like who is likely to survive through this. So they gave everybody money, and they gave even some of the crappier banks money, which essentially created zombie banks because these debt assets that they had were just so large they could never pay this back. They could never actually become profitable ever again. But they're just like, well, we're going to take the money. I mean, if you're going to give this to us, we're going to take it, right? So they did. Again, they created zombie banks. And until that practice actually ended, this kept going until they ended this and they started like scrutinizing it a little bit further, right? But what resulted in this was that this also, okay, so 1990, Japan entered what's called a liquidity trap. And it's essentially when monetary policy is unable to lower interest rates anymore because it's already at zero. Because that was the Fed's or the Bank of Japan's ace in the hole. It's like, oh, well, crisis. Okay, well, we don't want to spook people, but we want to keep economic activity going because everybody's so spooked. We'll just lower interest rates. So borrowing becomes cheaper. They can take more money out of the bank. They can go do stuff with it, R&D, spend it, all that sort of stuff. It'll keep economic activity going until, we get through this. The crisis is past or whatever. People feel safe again. Then we can raise interest rates. It's the same cycle. But in this case, they had no more room to move because it was already at zero. So stock and land prices fell to where essentially bank and institutions, they became insolvent because the 0% interest rates were happening. And because you're not having any sort of inflation, you start to also have deflation as well because no one's buying anything. You can make all this sort of stuff and all that sort of, make all that sort of stuff and everything. But like, again, this is a long history. I will get into that a little bit later, but I'm just going to stick current right now. But housing values essentially dropped and it left people with massive mortgages and devalued homes to the point where people couldn't move because the debt still chased them. Again, this is very synonymous of 2008's financial crisis, but obviously the supply remained constant, but the demand lowered because people just didn't have money to spend and they just couldn't buy any of these things, right? So, and on top of that, because a lot of these institutions and industries were shutting down, people were trying to look for work to essentially supplement their housing and just to be able to still keep it, right? Because the debt was just overbearing over them. People started to look for work, but because of the deflationary environment, wages became lower, and it also caused a spiral because it also deflated their income as well. And on the corporate side, though, the Japanese corporates, when they got this money, instead of creating economic activity as its intended purpose was to spend it on hiring new employees, to research and development, and so forth, right? They opted to pay down their current debt, rather than issue this out to people and just say like, okay, well, you want to make a business venture, here you go, it's interest rate is this amount, blah, blah, that sort of thing, right? They just said, okay, no, well, we have our own issues. We're just going to use that money to pay this down. And this was a bad idea because corporate investments was about a lot of their GDP. So it caused a really bad ripple effect in that. And they also stopped spending, similar to what the people did. They stopped spending on money, and they also started becoming savers and just really tightened up their the notch on their belt from spending. In both cases, the banks and the people needed interest rates to decrease again to stop or slow the deflationary spiral, but it just wasn't enough. Like, when you don't have inflation, you have stagnation, or in some cases deflation. Deflation sounds good, but there are good and bad to things on both sides. So move over to 1991. The Bank of Japan cut interest rates gradually every year for 6 years, from 6% to 2%, leading into the Asian financial crisis. Now, they weren't the ones that caused the Asian financial crisis, but that's a little bit later into the timeline. But so this is also the start of Japan's lost decade. The bubble was way too big. The asset bubble was way too big. And when the crash happened, it's also triggered deflation, which was continuing to be bad, which caused their economy to falter because it was less safe for banks to lend out their money because they just know they weren't going to get it back. So obviously, more money was injected into faltering firms, and it became another sort of situation where they went from window guidance and all that sort of stuff and QE into just financial stimulus. Again, we're going to throw more money at the problem and hope that this thing resolves itself, right? But the people at the time, I believe, I would like to believe that this was kind of their version of the Occupy Wall Street movement, but the people were unhappy about this because they kept giving money to the same people who caused the financial crisis in the first place and have us, not like really move forward from the situation. But the banking sector obviously this is kind of like a moot point, but the banking sector still continued the deflationary spiral despite the injection because it was just the asset bubble was just way too big and they were just in too deep. So we move over to 1995. The Plaza Accords are done. They just said we're done, and the USD starts to appreciate again, and Asian currencies pegged to the US dollar along for the ride. So this is when the Asian countries started essentially buying the US dollar. And this is a little manipulative because essentially they were doing this with the intent that, okay, well, our US dollar, we're gonna purposely devalue it. So we know that we're gonna sell this because we're forcing it to the value to go lower. Now we're just gonna stop this. So it makes sense why they would start acquiring US dollars at this time, and everybody else would start appreciating because they're holding on to that essentially US dollar, which is considered a safe asset. We move over to 1997 when the Asian financial crisis happened. And so what happened was that what started all this was that basically Thailand stopped pegging their currency to the US dollar, which meant that, if you guys don't know what I mean by that, it's basically when you keep a certain value, your currency at a certain value against another currency, which is in this case the US dollar. They stopped doing this. So like if, for example, I think they use bahts in Thailand, but the 1,000 Thailand bahts is like $10 in the US or whatever, right? That is the exchange rate that they want to keep it at. If it goes lower, the Bank of Thailand starts to buy it up so that it comes back in value. When it goes higher, it starts to sell its reserves to try to keep it down by that 1,000 to 10, whatever, 100 to 1 kind of exchange rate, right? But they just said, no, we're not going to do that anymore. We're just going to let it run however it wants to, right? So this cratered all the other Japanese ones because, again, like we're all interconnected in some way because of trade and everything, right? So in response, what Japan did was the Bank of Japan was actually, they were okay because they were actually acquiring US dollar and the US dollar wasn't hit too bad, but it's just because they weren't unable to cut interest rates again. They couldn't. So the US did what the US did. They started buying up internally. So they responded by buying their own US treasuries, which were used as a global investment by most of the world's government, monetary authority, and major banks. It's just the agreement that it was the notion at the time that the U.S. dollar was the safest dollar around because it was just confidence. There was a lot of confidence in there. This financial crisis was ended because the IMF decided to intervene and give about 110 billion in loans issued with a stricter term and condition, with higher tax rates, higher interest rates, drop in public spending, blah, blah. So this is very funny because this is almost like, with the tax rates, at least, I see this as similar to how, in the G7 recently, we had the global tax rates issued out. But whatever, this actually worked because they threw more money at the problem, and these countries started to recover 2 years later. Now, this is just a side thing that I had out there, but these are some of the possible lessons from this event. And first one is, be aware of asset bubbles. They do burst. And second is that the government needs to keep an eye on spending, any type of spending, infrastructure, who they give money to, just they need to follow the money essentially, right? Which they generally don't. They just kind of scatterblast it most of the time. Next one is foreign aid. So here's the reason why the IMF stepped in. Remember how I said everybody's interconnected? They are. In some way, shape, or form, because they trade for stuff, right? And if one of your partners fails, it's not good for you because, that might make up a good percentage of your GDP. And that would also knock off, depending on how sensitive your GDP is, it might actually knock you off. So again, it's a very touchy issue, but the only reason why foreign nations step in to bail out other countries is because they know that if they fail, they're going to take you with it. We're just that linked with each other. But